Welcome to Banking 101, a first principle jargon-free course on banking. In this lesson, we will continue to learn about payment services provided by banks to consumers and businesses. In this lesson, we will complete the discussion on payment rails that began in the previous lesson. We will cover the three rails that were not covered in the previous lesson, namely, checks, cards and crypto. Sue mails a check to her cell phone provider to pay her bill. We will call her bank, the check writer's bank. Adam works for the cell phone company. We will call his employer's primary bank, the depositor's bank, because Adam deposits the check there. Greg, an employee of the depositor's bank, presents the check Adam deposited to the writer's bank. But Greg's bank receives checks written on other banks. So, Greg travels to each of these banks. But it would be easier if Greg deposited all checks at a central hub. This central agency collates checks from all depositor banks, sorts the checks by the paying banks and sends them to the paying banks. We can take this to the next level. The depositor banks scan the checks and upload them to the central agency's database, from where the checks are assigned to the queue of the various paying banks. Instead of an employee at the depositor's bank scanning the check, some banks even allow customers to upload a digital image via smartphone. Data is automatically read from the checks using Meeker technology, which stands for magnetic ink character recognition. Checks are printed using special printers with magnetic ink. The bottom part of the check contains three numbers: a bank identifier, an account number and a check number. The checks are then scanned by readers designed to read the magnetic ink. Parts of the check-like amount could be handwritten. They are extracted using a combination of optical character recognition technology and human input. The thing to note is that once the paper check gets converted to a data file at the bank of the first deposit, the processing is similar to ACH. Imagine a country with two banks. Bank A receives deposits of checks whose writers bank with Bank B. Bank B is in the inverse position. After extracting data from the checks, both banks send the data files to a central agency, which calculates and sends net settlement amounts to the central bank. It so happens that there is a net amount to be transferred from Bank B to Bank A. The central bank debits Bank B and credits Bank A. The central agency also sends data files to the individual banks, who credit the beneficiaries and debit the payers. At this point, banks can compare the check images to the data files if they wish. The process by which checks are paid broadly follow these steps, though specifics vary by country. Let us now apply the three stages by which ownership of financial assets transfer to checks. The point of execution is when a beneficiary receives a signed check. Clearing refers to steps like extracting data from checks and calculating net settlement amounts. Settlement refers to transfer of funds between banks and account holder level credits and debits. Some banks may assume risk of insufficient funds by giving beneficiaries credit for a check prior to settlement. Next, we will move on to card-based payment rails. We learnt that banks perform three functions in payments. The way these play out in cards is specific to cards. Let us begin with the initiation step. Card payments can be initiated via various card instruments. A common instrument is a credit card. Every time we use our credit card, a loan is made by the card issuing bank on our behalf. A debit card, on the other hand, does not allow the consumer to spend funds in excess of what is held in the linked bank account. ATM cards are another common card type. When we use an ATM, we are paying ourselves instead of a merchant. Debit cards often double up as ATM cards. In prepaid cards, say a store gift card, the store pre-funds a bank account with funds, so that the cardholder can use the card like a debit card, with the difference that the account is funded by a third party. The authentication step ensures that the card is being used by the authorized cardholder and there are sufficient funds to back up the payment. Authentication rules are applied differently to in-store or card-present transactions and online or card-not-present transactions. We will begin with card-present transactions. For a card-present transaction, the cardholder must prove physical possession of a card by sharing card details to a card reader. Historically, these details, including the account number and expiration date, are encoded in a magnetic stripe that is swiped against a reader. The magnetic stripe also contains data which is not physically embossed on the card. However, the data on the stripe is static. Hence, a malicious party can create a counterfeit by extracting this data with a card reader. To overcome this concern, new methods have evolved. The new methods of encoding card details are insertable chip cards, contactless chip cards and contactless smartphones. A detailed understanding of these is outside the scope of this lesson. What is common to all four methods is the encoding of card details in a physical object so that a card reader can read them. What is different is that non-magnetic stripe method generate dynamic one-time codes at each transaction. Thus, fraudsters cannot use a card they don't physically possess for card-present transactions. Since not all merchants have the readers necessary for chips and smartphones, the same physical card often supports all four technologies. We can now apply the possession, knowledge, adherence framework to card-present transactions. We already reviewed the four methods of proving physical possession. Moving on from possession to knowledge, card-issuing banks rely on our knowledge of PINs, especially for debit and ATM cards. Some banks may also send a one-time password to our phone at the point of payment. As far as adherence goes, authentication involves comparing a wet signature on the back of the card with the cardholder's signature on the merchant's receipt. Card-not-present transactions carry a higher risk of fraud because physical possession cannot be verified. Most websites test our knowledge of card details, including card number and expiration date. When making card-based purchases through our smartphone, features like facial recognition may also be used. For card authentication to work, the card user must connect to the card-issuing bank at the point of payment, which may be a store, an ATM, or a website. Let us look at the exact workflow by which authentication occurs at the point of sale. There are four parties to a card transaction: the consumer, the merchant, the issuing bank, and the acquiring bank. The card-issuing bank opens the bank account to which a debit card is linked. Alternatively, for credit cards, the issuing bank issues a credit limit. The acquiring bank enables the merchant to receive card payments by facilitating their linkage to card networks. The acquiring bank also receives funds from the issuing bank on behalf of the merchant. Next, we will review how these parties interact. Step 1. An issuing bank opens a bank account or credit line for the customer and issues a linked card. Step 2. The cardholder uses the card either in-store or online. Step 3. A message is conveyed from the point-of-sale terminal or website to the acquiring bank's payments processor. Some acquiring banks process the incoming payment themselves. Step 4. The acquirer's payment processor routes the transaction to the applicable card network operator, like Visa and MasterCard. Step 5. The network operator routes the transaction to the issuing bank for approval. Step 6. The bank issuing the card validates whether the cardholder has enough funds associated with the card. Some issuing banks may outsource this data processing step to a third party. Step 7. The network operator transmits the approval back to the acquiring bank's payment processor. Step 8. The acquirer's processor transmits the approval to the point of sale in the form of a response code. Step 9. At the end of the day, the merchant sends a consolidated data file to the network. This data is mostly the same as Step 8 but with some changes. For example, it may exclude items that the merchant has not shipped yet but includes the tip customer's handwrote. The end-of-day file forms the basis of funds transfer from the issuing bank to the acquiring bank and finally to the merchant. So far, we have touched upon the base levels of authentication like verifying identity of the payer and checking for sufficient funds. But card authentication can involve more complex rules. For instance, checking the geographic location from which a card is being used for fraud detection. Or ensuring that a food delivery employee can only use the card to pay for food pickup at network restaurants. Historically, card issuers were authenticating incoming transactions. However, as need for more complex authentication rules emerge, these two activities are getting decoupled. The issuance of a card with a linked bank account or credit line can be done by a bank while the issuer processing is done by a fintech. A third role in card issuance is that of a brand sponsor. An example is the store on a private label credit card. So far, we learned about initiation and authentication steps. But how does money transfer between cardholder and merchant? At end of day, the network operator sends data to all issuing banks on the total amount they need to transfer on behalf of their cardholders. Data is also sent to the acquiring banks on the amounts they should expect. There may be some adjustments to the values that were approved during the day. For instance, handwritten tips on restaurant receipts get added. The next step is the transfer of funds. From issuing banks to acquiring banks, the transfer is usually done by wires. Transfer from the acquiring bank to the merchants is usually done via ACH. Of course, if the merchant's operating bank account resides with the acquiring bank, then it is a simple book entry within the bank. Thus, we can see that the merchant receives cash with considerable lag from the point of sale. How do the three stages of financial assets ownership transfer apply to cards? The point of execution is when payment is authorized by the issuing bank. Clearing refers to the end-of-day steps where the transaction history is finalized and data files are sent to participating banks. Finally, the transaction settles with transfer of funds from the issuing bank to the acquiring bank via wires and then finally to the merchant via ACH. This slide summarizes some of the roles within a card payment. A deep study of card payments is outside our scope. However, we will cover three major variants of the card workflow. Historically, acquiring banks served larger merchants. A lemonade stand operator could not get a merchant account from them. The industry was disrupted by payment facilitators like Square. The payment facilitators get a merchant account from the acquiring banks and allow numerous small merchants to use it, similar to subletting an apartment. The small merchant gets a sub-merchant account. So far, we have learnt that the issuing bank represents the cardholder and the acquiring bank represents the merchant. Closed-loop systems are those where both must be the same for the payment to work. American Express and Discover are closed-loop systems. The problem with closed-loop systems is that the card issuer must also acquire merchants to accept their card. In an open-loop system, the card issuer and merchant acquiring bank need not be the same as they are connected via card networks. More broadly, in an open-loop system, the payer and beneficiaries' banks need not be the same as a payment rail operator connects them. ACH and wires are open-loop systems. Card issuing banks often issue co-branded cards with large merchants that can be used at the merchant stores. In these cases, the issuing bank and the acquiring bank are the same. These so-called honest transactions bypass the card networks. More broadly, honest transactions are those where the payer and beneficiaries' banks are the same, because of which the payment rail can be bypassed. This can occur across all payment rails including wires, ACH and checks. This brings us the economics of card payments. For this analysis, we will exclude interest earned on credit card customers. The amount spent is referred to as gross merchandise volume. If we spent 100 at a store, the merchant, on an average, gets 98, though this varies by type of transaction. A major portion of this margin, called interchange fees, accrues to the card issuer and funds reward points. The remaining is split between acquiring banks, payment facilitators and card networks. In case of honest transactions and closed-loop systems, the issuing bank does not have to share revenues with other parties. The interchange fees is a compensation to the issuing bank for the credit and fraud risk they are assuming in card transactions. The fees are set by network operators, though in some cases, like debit cards in the US, they are regulated by the central bank. Interchange is collected by acquiring banks from merchants and paid to issuing banks. Let us summarize the role of the networks. As we have seen, they facilitate authentication and settlement. They set rules for the network. For instance, they may say if a merchant doesn't have a chip-compliant reader, the liability for fraud shifts to the merchant. They set interchange fees based on elaborate parameters, though, the fees accrues to the issuing bank. For instance, card-not-present transactions incur higher interchange than in-store. MasterCard and Visa's interchange fee schedule can be downloaded from the open internet. We can think of credit cards and buy now pay later as two alternate methods of initiating payments. BNPL usually does not require the use of a card. The commonality between both methods is that the payment is made by a lender on behalf of the consumer. When an online shopper selects BNPL option on checkout, she is directed to the website of the BNPL. The lender makes an instantaneous credit decision on the purchase. Each transaction is assessed individually. The payment from lender to merchant may occur next day by wire or ACH. The lender takes a cut from each sale, similar to the interchange fees. The repayment by the consumer to the lender mostly occurs by debit card, as the product is used by consumers who do not wish to use credit cards. In closed-loop BNPL, the lender and the merchant are directly connected without need for a card network. In open-loop BNPL, the lender and merchants rely on a payment network operator like MasterCard and Visa. We will now synthesize our learnings on the role of banks in card payments. We will begin with the issuing bank's perspective. At initiation, the issuing bank opens bank accounts and credit lines, and issues cards linked to those accounts. It also funds rewards programs to encourage card usage. In the authentication stage, the issuing bank assumes the financial risk of fraudulent card usage. Credit card issuers assume credit risk that the consumer won't repay them. Also, consumers can dispute charges on their cards. These are called chargebacks. If the merchant does not issue a refund, under certain circumstances the issuing bank may have to foot the bill. Finally, issuing banks facilitate the transfer of funds via payment rails. Next, we will look at the acquiring bank's perspective. The acquiring bank provides infrastructure to the merchant for payment acceptance. This may include the point-of-sale hardware, though the merchant can buy that from a third party. The acquiring bank assumes financial risk of fraud by the merchant. It acquires the transactions at the point of sale and forwards them for approval to the issuing banks. It assumes chargeback risk in the event the merchant, say an airline, goes out of business before delivering what has been paid for. Finally, the acquiring bank facilitates the transfer of funds via payment rails. Now that we are done with cards, let's move to cryptocurrency. We can think of cryptocurrencies as digital equivalents of fiat money that resides on a special type of database called the blockchain. While fiat money is tracked in a bank system, cryptocurrency is recorded in the blockchain. To understand cryptocurrency better, first, we will learn about how fiat currency works. Consider Susan, Peter, and Paul. Susan gives Peter a dollar bill. She cannot give the same dollar bill to Paul. Paper money cannot be spent twice. Now Susan takes the image of the dollar bill and sends them to both Peter and Paul. This is a problem because she is double spending the same money. So how is the problem of double spending solved for digital money? The problem of double spending is solved through a trusted record keeper, which is Susan's bank. Susan has $100 in her bank account. If she sends $1 to Peter, the bank will deduct her balance. She cannot send the same money twice. The bank performs the following functions for digital fiat currency. It issues bank accounts with unique identifiers. It restricts access to the accounts via PINs, usernames and passwords. It prevents double spending by keeping the book of record. Cryptocurrency is a technology solution that recreates the functions of bank and digital money without the need of any central party. Learning how the technology solves for the banking functions like secure access and prevention of double spending is outside the scope of this lesson. The takeaway is that cryptocurrency technology recreates the properties of digital money without the need of any trusted record keeper. In the traditional system, the bank account of the sender and the bank account of the recipient are held within the databases of two banks, each of which is a walled garden. Payment rails are needed to connect them. In the cryptocurrency ecosystem, the blockchain address of the sender and receiver are analogous to bank accounts. Just as money held in our bank accounts are stores of economic value, so are the cryptocurrency balances in the blockchain. However, since they are sitting in the same blockchain database instead of in separate walled gardens, no payment rails are needed. Regardless of whether cryptocurrencies become a reality, the presence of this technology reduces the ability of banks and card networks to charge a fee for access to payment rails. Bob converts some US dollars to cryptocurrency using a crypto exchange, the same way he would buy stocks with cash. He then sends the cryptocurrency to Sam, who lives in Germany. Sam then sells the cryptocurrency on a crypto exchange and gets euros in return. The reason Bob and Sam go back and forth between fiat and cryptocurrency is that many merchants don't accept cryptocurrency as a form of payment. But imagine a world where everyone accepted cryptocurrency. In that world, Sam could simply keep the cryptocurrency in its native state. Email was a digital native equivalent of snail mail. It would be strange if email required postage stamps. Hence, cryptocurrency can be thought of as a payment rail for the digital age. While the analogy between email and cryptocurrency as digital native equivalents of their legacy counterparts makes sense from a functional perspective, currency has broader impacts, including areas like financing of crimes and monetary policy. Hence, cryptocurrencies are likely to be more tightly regulated than communication mediums like email. We can think of cryptocurrency in two dimensions. The first dimension, which gets a lot of press, is the exchange rate of cryptocurrency to fiat currency. The second dimension is the underlying technology that enables frictionless transfer of value from one party to another. Separating the two dimensions helps us distinguish between cryptocurrencies as a financial asset and their function as a payment rail for transferring value. Next, we will see an example of how the volatility of the first dimension can get resolved through stable coins. Alice pays James $1. James issues a token on the blockchain. He then invests the dollar in a very low-risk investment like a bank time deposit, earning a small amount of interest. James guarantees that to redeem the token for fiat currency at $1. The token James issued is called a stablecoin. Now that the exchange rate of crypto to fiat currency has been stabilized, sellers of goods and services may be open to being paid in crypto. This illustration demonstrates that the payment rail aspect of cryptocurrency is different from the issue of its intrinsic value. Crypto payments are a vast topic and outside the scope of this lesson. But let us quickly recap the takeaways. First, cryptocurrency leverages technology that recreates the properties of digital fiat currency. Second, since everyone stores cryptocurrency on the same database, no payment rails is necessary. Third, In understanding cryptocurrency, we need to separate the two dimensions of cryptocurrency, its source of intrinsic value and its utility as a payment rail. Now that we have covered all payment rails, we can classify them into push versus pull. In pull-based rails, payments are pulled from payer's account. Hence, the beneficiary must know the payer's account details. In push-based rails, the payer pushes the payment. The payer must know the beneficiary's account details. In pull-based systems, the payer communicates her account details to the beneficiary in many ways. These include conveying details to a card reader, typing in details on a website, filling a direct debit authorization form, or handing over a check which has the payer's account details on it. In push-based systems, the beneficiary usually has to email or text the account details to the payer. In modern payments, ways of disguising account details for additional security have evolved. One set of methods includes using aliases like email and phone numbers that are mapped to bank accounts in the background. Another set involves use of QR codes, which are similar to barcodes at supermarkets. But in payments, instead of mapping to a product, it is mapped to a bank account. We have now completed a well-rounded introduction to payments. In this section, we will synthesize our learnings on the role of the banks in each of the three stages of payments. Let us begin with initiation. Banks offer multiple types of instruments to initiate payments. They include cards, paper-based instruments, and non-card-based electronic methods. But customers today want to initiate payments from multiple channels, not just multiple instruments. Banks must support multiple payment channels. These include banks' own website and apps, as well as third-party payment apps like peer-to-peer apps. Customers may want to pay in-store, or they may pay online through merchant apps and websites when engaging in online shopping. Business customers may want to initiate payments directly from their enterprise applications. For example, a customer may send a payroll file directly to the bank from its payroll system. Next, coming to authentication, banks offer multiple ways to ensure that only authorized individuals with sufficient funds are initiating payments. These include proofs of physical possession, knowledge of passwords and PINs, as well as inherent characteristics like biometrics. Banks adopt technologies to protect themselves and their customers from payments fraud. Some apply to cards like chip and tokenizations. Other techniques include analytics-based warning signals like a customer making an unusual purchase. Continuing with authentication, banks enforce compliance rules specific to business customers. For example, one business customer may require that business credit cards cannot be used at certain types of merchants. Another may require that 2 employees must authorize each wire. Banks assume risk of payment fraud. In case of credit cards, issuing banks assume the risk that the customer may not pay back. Credit risk is not exclusive to cards. For instance, a bank may give immediate credit on a check deposit or an ACH deposit without waiting for funds to clear. Banks assume chargeback risk. A credit card customer may dispute a charge from a merchant. A bank may find that a consumer is disputing an ACH debit and they have to restore funds to them. Banks can institute policies that limit the amount of credit and chargeback risks they are exposed to while being in compliance with regulations. Finally, banks enable value to be transferred from one bank to another via payment rails. They also secure foreign exchange for cross-border payments. As part of the payment rails, banks may assume credit risk and compliance risk with counterparties like beneficiary banks and correspondent banks. For instance, in a real-time payment system, there is a possibility that the other bank goes bust prior to settlement. Similarly, banks may allow temporary overdrafts on the Nostro accounts held by correspondent banks. We have seen what banks do in payments. But how do they make money in payments? The first category are transaction fees. These are either collected from payers like wire transfer fees or from beneficiaries, like interchange fees. The second category are income linked to interest rates and foreign exchange rates. Float interest earned on in-transit balances is included within this category. In cross-border payments, banks make profits by buying foreign exchange at a lower rate than what they offer to clients. The third category are services that are ancillary to payments. For instance, a bank can offer payroll management services in conjunction with making the ACH payments for salaries. So far, we have viewed the payments product as individual Lego blocks across the steps of initiation, authentication, and value transfer. But the payments product provider, whether a bank or a non-bank, can also orchestrate the Lego blocks in a way that enables a business solution. Next, we will look at an example. Claire works for a food delivery business. She picks up food from restaurants and delivers to those who order. But how would she pay each restaurant as she picks up food? Her employer can give all delivery employees a business credit card. But this is risky, since there is no easy way to stop someone from using the credit card for personal expenditure. Further, many food deliverers may not even be employees but contractors. Enter a payments-focused fintech whose customer is the food delivery company. The fintech opens a bank account with a regulated bank. The bank issues credit or debit cards which are handed over to the food deliverers. So far, nothing is different from the legacy process. But here is the difference. When we use a debit or credit card, the issuing bank validates whether we have sufficient funds. But the fintech's platform can apply far more complex rules. For instance, a transaction is approved only if it occurs within a network restaurant. Further, it is only approved for the order amount Claire is fulfilling at the restaurant. The takeaway is that payments as a product can be an enabler of business, not just a transactional service. This ends our lesson on payments. Payments is a horizontal product that is part of both consumer and wholesale banking. Certain payment methods like card payments are more common in consumer banking as against wholesale banking. However, the core payment product itself remains the same. Please review the summing up section of this lesson. I will see you on the other side.